Imagine you had the ability to sneak a peek at Warren Buffett's shopping cart or check out what Michael Burry is hoarding like it's another round of the Big Short. Well, that's exactly what we're doing today. Minus the legal troubles, of course. So we've analysed the latest 13F filings from some of the greatest investors of our time, and we've uncovered the top 5 stocks they've been quietly accumulating over the past quarter in Q4 of 2024. And let me assure you, there are definitely some surprises. So stick around because we're not just listing stocks, we are breaking down why these companies are attracting billions of dollars from the smartest money on Wall Street, what's their competitive edge, and most importantly, their upsides and downsides as potential investments. And before we jump in, a quick note on where this data is coming from. So there's a fantastic platform called DataRoma that tracks the top fund managers, what they're buying and selling based on their quarterly 13F filings. Essentially, they have to make their portfolio public. Now, these reports don't show real-time purchases, but they give us a window into what the super investors were doing recently, at least in the past few quarters. So it's like a treasure map to their investing mindset. Of course, that's dependent on whether you can interpret it. Now, let's get into the 5 stocks that the big guys have been piling into. So the first one on the list is none other than Microsoft, the household tech titan. So in the last quarter, they've seen as much as 12 fund managers triggering a buy transaction of this company. So for reference, Microsoft was trading between $406 to $454 per share in that time frame. And Microsoft needs no introduction. This is the giant that brought us Windows, then Office with Xbox, and now scaling extremely quickly in the cloud computing space with Microsoft Azure. So the investing thesis for Microsoft should be relatively straightforward. It's the king of software with near monopoly powers in several areas. So over the years, they've built up very strong, predictable, recurring revenue streams, from Office to their enterprise solutions. And just looking at their growth and margins alone would make any investor smile. Furthermore, they've also smartly positioned themselves to catch the 2 next biggest wave, cloud computing and artificial intelligence. So there's really not much we can complain about. However, I think the larger part of the skepticism on the street might potentially be the existing consensus and valuations investors are worried about. So not so much about arguing that Microsoft is overvalued per se, but more so because we want a larger discount. I mean, who wouldn't? And also, not forgetting about the race to build up the whole AI infrastructure. And all the major tech players are sinking in hundreds of billions of dollars, which is in direct competition with returning the capital back to shareholder for the next growth frontier. Of course, there's not much guarantee in place as to how much returns that we're looking at. Therefore, that's a risk that investors have to be comfortable with. So looking at Microsoft's valuations today, they're trading at roughly a 28 times forward PE, price to earnings ratio, with top line growth expected to be between 13 to 15%. So for such a high quality company, I won't necessarily say that it's a steal, but it's definitely not a bad buy. Interestingly, on a side note, the Bill and Melinda Gates Foundation, of course representing Bill Gates, who founded Microsoft, did trim their Microsoft position by a little bit in the same quarter, although not considered significant in the grander scheme of things. Now, do remember that investors sell for all sorts of reasons, but buy for only one. Moving on, the second on the list is Ferguson Enterprises. So we saw 6 fund managers buying into the company in Q4 of 2024. So Ferguson is a leading distributor of plumbing and heating products in the US and Canada. So sounds boring, isn't it? Well, it's probably one of those classic Buffett-style stocks with strong fundamentals, steady or even low growth, and the most important thing, they have an unshakable market position. That said, they've not seen much growth over the past 2.5 years already. So they're in the essentials business, which would probably suggest that they're more resilient in the economic boom and bust cycles. Furthermore, with their market leader position, I don't think they're going anywhere anytime soon. On top of that, especially in the recessionary period, people will probably tend to congregate to what they're comfortable with. That said, it's definitely not a sexy or even flashy business to invest in. So their core business growth is tied to the construction market. And right now, consensus amongst analysts is that they will continue to grow between 2 to 5% in the coming 2 years, whilst still trading at a forward PE of 20 times and a forward price to cash flow of roughly 18 times. So this business is most probably here to stay, but as an investment, you need to know how it will fit into your overall portfolio objectives. Now, I have something really exciting to share. So Piranha Profits has recently launched a weekly investing newsletter called Investing Bites. Every week, you'll get bite-sized lessons, stories, and investing wisdom from us. Plus, at the start of each month, we spotlight a company on our radar, coupled with our team's analysis on it. So if you want insights sent right to your inbox, you can subscribe to Investing Bites for free using the link down below. So we've prepared a juicy first issue spotlighting a pharmaceutical company that's experienced a more than 50% decline in the share price. So just hop onto the page using the link below to find out more. The third on the list is Equifax Incorporated, the credit powerhouse. Similarly, we saw 6 funds buying into them. So you might know Equifax from your credit report, and specific to this company, they operate with proprietary data that financial players rely heavily on, hence creating the moat around them. And Equifax has demonstrated resilience by growing their mortgage-related revenues despite high mortgage rates due to the slower than expected rate cuts. Furthermore, their international portfolio, particularly in the Latin America geography, provided greater diversification beyond the US macro environment. And margin improvements can also be seen through their cloud transition efforts, also thereby improving their profitability metrics. However, the near-term outlook remains pressured. So their guidance in the most recent earnings for the coming year actually suggests a slowdown in growth, reflecting ongoing weaknesses in the mortgage inquiries and hiring trends. So mortgage inquiries specifically are expected to decline another 12% in 2025. So while Equifax is definitely a strong and resilient company with a proven track record, the market acknowledges that by according them with a relatively high multiple of a 30 times forward PE, even without much growth expected ahead. So compared to their 5-year average, its valuation today is on the higher side, which does not offer a strong margin of safety for any investors buying into it today. Now, the fourth on the list is Berkshire Hathaway, and it's essentially a bet on Buffett's legacy alone. I think I don't really need to build a case for the legend himself. And owning Berkshire is like building an ETF on its own with a mixture of great businesses, handpicked by Buffett and his team of lieutenants. Of course, not forgetting the insurance float that is basically free leverage for his investment portfolio. And currently, we have seen many headlines talking about Berkshire's record cash pile, which means that investors will be able to benefit greatly from the next big crash, and who knows when it's going to come. And on that same note, many can look at having this Berkshire exposure as a defensive pick to stabilize the portfolio, even during market downturns. And the mandate that Warren Buffett gets from his investors is his long-standing track record and focus on compounding their wealth regardless of market conditions. So the only pushback that I personally have is that Buffett himself has also stopped acquiring back its own share since June of 2024, which might probably suggest that the valuations of Berkshire itself might not be deemed as undervalued in his own books. So I think that's just a food for thought. Lastly, we have Pinduoduo, with 5 funds adding into it. Yeah, you heard it right. A Chinese company, Pinduoduo Incorporated, favored by super investors like Michael Burry, David Tepper, and Robert Vinyl. Pinduoduo is one of the fastest growing e-commerce company, period. They're not only causing massive shockwaves in their local Chinese e-commerce industry, rivaling that of Alibaba and JD, but they've also scaled very aggressively into the States with their Temu arm, revolutionizing the industry with a social e-commerce approach, focusing on a C2M business model, which is consumer to manufacturer, that was proven to be highly scalable and well-loved by the consumers. Clearly, as a Chinese company, they face similar scrutiny of financial integrity, shareholder interests, regulatory risks, geopolitical tensions, to just name a few. Furthermore, the explosion of Temu's growth moving forward might be a lot more muted due to the restrictions of cross-border trades with Trump's tariff plan in the making. And I must say, everything looks great on paper, and I really mean everything. Just to show you how they've grown over the last 5 years or so, easily between 50 to 100% year-on-year growth. And with a projected growth rate of at least 20% in the coming 2 years, they're trading at a forward PE of 10 times and a price to cash flow of 9x. You heard that right. Competition remains stiff and a lot of external challenges that the management has to navigate. But given their current valuations, it's as though the market has either overcompensated for the above mentioned risk or they just don't believe their numbers. So I'll stop here and I'll let you do your own due diligence on this company. Now, just because these investing legends bought into these stocks, you should not rush to copy them. However, what you can do is to take this information and use it as a starting point of your own research. Ask yourself, do these stocks fit your investment strategy? Do you understand the possible risks involved? And do you have the conviction and, more importantly, the understanding of these companies mentioned to hold on to them for the long term? And possibly change your opinion if the facts or execution change. At the end of the day, the best investors don't just follow the herd. They understand the why behind every investment. Now, I want to hear from you. Do any of these stocks interest you? And are there any other companies you think super investors should be buying? Drop your thoughts in the comments below and let's discuss. So this is CK from Piranha Profit signing off. Till next time, keep winning.